And here we go, everyone. This is going to be your election day or election week. We've got about 3, 4, 5 days or something like that before the election. So we are going to talk about where we are right now, what the market normally acts like during the election year, after the election's over. We're going to talk about some scenarios like a Biden win, a Trump win, a blue sweep, a red sweep, a blue contested, a red contested. We'll talk about all those scenarios. We're going to go over one of the stupidest charts I've ever seen, or graphs, or whatever the hell you want to call it. And we're also going to just take a look at the value to growth rotation and how it is kind of unfolding over the last 3 or 4 months. So let's jump right in. Let's just start with where we're at right now. As you can see, as long as we hold this low, somewhere around 3240, 3250 in the S&P 500, if we can hold that low, then we're going to be in good shape. Your next scenario is if we lose this low, which I really hope we don't do, because then it's just going to take more time to develop. We're going to end up coming down to about 2,900, which is about the center of this pattern where all of this volume is built up. So as long as we don't lose this low, we're not going to visit 2,900. So hopefully we just kind of grind sideways for the rest of the year going into 2021, and then hopefully we can get back off to the races. At this point in time, there's more tailwinds than there is headwinds. So what I mean by that is there's more stimulus to come. The Federal Reserve, continues to have a very easy monetary policy, and it's only going to stay. It's just going to stay that way for the next 3-4 years. If you look back to the 2008-2009 financial crisis, it took them about 8-9 years to start tightening again. So we can have possibly a very, very easy Fed for the next almost decade. So that's really good. So that's a great tailwind. So we got stimulus, we got a vaccine, we got the Fed all providing this tailwind. But on the flip side of that, we still have a couple of things we have to get out of the way. And that is, one, the election, which means regardless of who wins, we need to make sure that we get through it smoothly, meaning not contested. One of the main points that I want to make is that when we get to scenarios later on, the only thing that matters is how quickly we get stimulus. That is the only thing that matters. And whatever scenario gets us to stimulus quickest, that's the best case scenario. So it has nothing to do with politics, has nothing to do with anything. You just have to understand what the market wants. The market wants more stimulus. It always wants more stimulus. And so that's where we're at right now. So something really to look at here. So we are, like many election seasons, September, we top in the first week of September, and then we head lower. We have some kind of volatility going into the election. I've circled some of the times that we've done that. You can see 2016, you topped in September-ish, right? First week of September, you're right about the top. Come on in. And a lot of people forget this, but that was a really bad candle. And honestly, that was a really bad, say, month and a half coming into the election. I mean, you're talking about every single time you got a green day, it was followed by a red day. And then you get a little bit of momentum, and then you get smacked right back down. A little bit more momentum, smacked right back down. I mean, this, if you're a trader, which, when I'm not investing for clients, I am a trader. This is a grueling process to trade through. Just absolutely getting no traction, and just like the feel that it's always going to just be dripping lower. Very, very tough environment, and that's what we experienced in 2016. But the second the election was over, and again, I'm going to say this, you probably heard me say this a bunch of times. It didn't matter who won the presidential election in 2016. The market was going to go higher. it was the only thing that was going to matter was which industries and which sectors were going to lead us out of this move. And that's what was determined. If you were to overlay this with, say, like a Alcoa, if you were to overlay this with like I think it was maybe like US Steel, maybe even like an Exxon, I think. Like, what's crazy is that maybe not Exxon, but the materials plays. So here's your coming into September. The materials plays were the first things that let us out of that dip, which is pretty incredible to think of because they've been beaten down to crap ever since. But so that's 2016. So top in September, volatility until election. 2012, you kind of have a top again in September, crash down into election. I think the election day was actually, I think it was the 5th in 2012, one of these days. So there's your election, and then boom, comes down, maybe a week or two more downside, and then off to the races. Now, 2008 was obviously a little bit different. We were in the midst of the global financial crisis, but you had August, kind of this like choppy rounding top pattern here. That again, so kind of like your first week of September, your mid-August top, crashing down in October. October seems to be a pretty bad month for election years. You get a little bit of a rebound and then come back down. So now that was obviously a much different story because we were in the midst of a global financial crisis. Here's your 2004 election. You bottomed in August of 2004. You kind of topped out again September, October. You came in before the election and then off to the races. Here's another. This is an interesting one. Now this is the dot-com bubble. So the dot-com bubble, again, you top in September-ish. You had a prior high in March and April, but you kind of have this little top in September. Down we go, and then that was pretty grueling process for people to live through. Just as a reminder, that's what a 50% drop looks like in the market. Let's go look at another one. So that was 2000. So 1996, right? So a little bit of downward movement coming into the election, off to the races, right? So we don't really need to go and look at every single one of those scenarios, but just understand that where we're at right now, you kind of see how important this is, building out this range. These ranges are always very important. From just a technical perspective, what you're doing is you're building buyers and sellers around a prior high. But not only that, you get your first drop in September. September, the first week, there's your top. You come down. And what you do is you test your buyers down here and you test your sellers up there. And you keep doing that, testing buyers, testing sellers. And then you find some balance and then off to the races. So that's where we're at right now. Let's take a quick look at the seasonality. So seasonal pattern since 1901. This is the election year, and this is what happens when the incumbent party wins, when they lose. No sitting president running. 2016, all presidential election years in aggregate in 8 years. So what this is trying to accomplish is trying to show you what normally happens through the course of an election year. And what you're going to notice is that in many cases, you get this little area where it's like a top in September, and then down you go, and then you catch, you keep going down, and then in November, that's kind of where things start to perk up a little bit. So top in September, come down to October, November, and then get going. Now, that's when the incumbent party loses. That's like, I guess, an 8-year aggregate or maybe an 8-year rolling. You got your no sitting president running. You have incumbent party win, which looks like the best case scenario, right? And then incumbent party loss. So, however, even though since 1901 incumbent party winning has showed the best returns, I'm going to make the case for why that's not the best outcome for this election in terms of how the market trades. Before we go any further, I'm going to show you the stupidest thing I've ever seen in my life. And what this is a Gallup approval poll and then growth of $100,000. So if you look at a lot of investment bank slides, they all look like this. They're really fancy. They're kind of cool to look at. You know, you got your presidents and the colors in the back, all that stuff, right? It's like, oh, this kind of a cool chart. This is a perfect example of the amount of things that are put out there that is strictly correlation, not causation. We're going to look at another chart too that's going to show you, I think I have it here, that, and I see this all the time. Oh, when Republicans win, the market doesn't do as well. When Democrats win, the market does better. Just understand how much crap that all is, right? This market just goes up. It's what it does over periods of time. It is not causation. The president does not determine the direction of the market. The one thing you can say about Trump is that because he roots on the market, that it's created more and more participation within the market. It doesn't necessarily mean that because Trump became president, the market was going to go up more than if Hillary became president. And same thing with Obama, same thing with Bush, same thing with Clinton, and so on and so forth. The main point I want to make is you're always going to see that type of stuff out there, but it's more correlation than causation. All right. So there's no cause and effect to a president, but a president becoming president, and then all of a sudden, he's the reason the market went higher, or the Republican became president, or Democrat became president. That's why the market went higher. You're going to see tons and tons of that stuff out there. Just been seeing it all year. It just makes me so sick because it's so stupid. But this just goes to show that not many. Hoover had a bad run at it. It looks like, but besides that, we've just kind of been off to the races, right? Let's talk a little bit about this rotation. So August, month over month change in global fund manager positioning. Small moved into large, value moved in value greater than growth, small greater than large, meaning money came out of large caps, went into small. Money came out of growth, went into value, okay? Again, in September, more money was moving into value, more money was moving into small caps. Understand that there's a lot of small caps out there, lots and lots of small caps that represent value. And really, it happens in the industrial space. It happens in the material space. There's tons and tons of them out there. So just understand when you do see these values in these small caps, you're really looking at a swing into value. Global fund managers are starting to move billions of dollars into value right in front of our eyes. And it's something to really consider because, again, when you want to talk about risk, your highest risk levels right now is being in tech, is being in growth. It's the most exciting. It creates the highest peaks, right? It creates the most amount of money the quickest. But, when you go parabolic, it never ends well. So, and then I think October as well. So you had a little bit lightening up in October, but it's still moving in that direction. The one thing that's kind of crazy is the amount of money that's going into healthcare recently. Just really, really, there was, I think it was, September, money started coming out of healthcare. Money came back into healthcare in October. Now, this is like a bet on Biden, right? Like if you're going to bet on Biden, you're going to bet on China, you're going to bet on healthcare, you're going to bet on cannabis, you're going to bet on renewable energy like solar, and you're going to stay the hell away from energy like they have been for 10 years. And banks are never a good thing either because he just wants to tax the crap out of the banks. So that's where we're moving. So we are moving into value. You can get a good sense of that just by looking at, we've looked at Tupperware a few times, but this thing just absolutely off to the races. when you think of value, think of store of value, right? Like, even though this company is never going to cure cancer, even though this company doesn't do anything spectacular, right? They are a store of value. They are going to sell Tupperware until the end of our days. And when you say, oh, well, it's made of plastic, they're going to get rid of plastic, Tupperware will figure out how to make disposable Tupperware for you. They will. So just keep that in mind. I'm always surprised when people think that it's so easy to phase out, multi-billion-dollar companies. It doesn't happen like that. These companies will change. So, but FedEx is another one. FedEx just absolutely ripping. If you just look at like the XL, the VAW, which is materials, absolutely ripped. Industrials have done pretty well, not as good as materials. Banks and energy are the ones that have just been beaten down the most. These things have barely gotten off the mat. And energy's got it just for. Wait, energy was up today? How is that even possible? Didn't even notice that. That's interesting. Market got murdered today for a little bit. So energy, obviously it's not an exciting place to put your money, but it's going to pay you a huge dividend, and it is just so beaten down right now. And again, you're looking at prices that we haven't seen in a very, very long time, if ever, right? So that's one of the things to always keep in mind. Let's get rid of that. So this is something that's really interesting as well, something to really consider here, that the investment community knows that tech and growth is the most crowded trade and has been for quite a long time. So even back in 2018, when it said Long Fang, which was Facebook, Apple, Amazon, Netflix, and Google, that's still leaning on growth. That's still leaning on technology, just like we are now. So just understand, we've been long technology, long growth for the better part, even in 2017, for the better part of 3 years. It's had an extremely good run. It's had an incredible run in 2020. It had a great run in 2019. But, unfortunately, all good things must come to an end. And this is going to be one of those things when the time comes. You want to look at some interesting things out there. I'm going to show you how to look up IPOs right now. Go into FinViz, go to IPO date, and I'm pretty sure you can look this up, but I don't think you need Elite to look it up like this. But in the last 5 years, IPOs in the last 3 years, IPOs in the last 5 years, right? And then normally I just like to go by market cap first, and then just go down from there. So if you look at some of these companies like Zoom, right, Snap, software. Just tons of multi-billion-dollar software companies. DocuSign, just running away with it. Just absolutely running away with the market. Pins, which is like, they're going to be an incredible company down the road if they're not already one. But again, that's like internet software technology. These IPO names, these multi-billion-dollar IPOs like Match Group, it's unbelievable that they get as much, that they're valued at $29 billion. Datadog, CrowdStrike, OKTA. You look at just software, Unity software, gaming, and they do a bunch of other applications. The Trade Desk, Roku. It's like growth in technology IPOs, along with FANG, have driven this market very high and have become a huge portion of the index. Something that happened today, you could see that Amazon is kind of in the same, doing the same thing that the index is doing, right? Because the index is Amazon, and Amazon is the index at this point, just because it has such a high weighting within the index. So you can see that Amazon just got absolutely beaten up. 5.45% in Amazon is a lot. 5.6% in Apple is a lot. Facebook down 6.3%. That is a lot. Netflix down almost 6%. That is a lot. The reason I'm saying it like this is because you're starting to see these things lose traction, right? Amazon is probably still looks the best because it's kind of just building out a range. You look at things like, Facebook comes up, loses it, and it's, if it loses this here, ish, sayonara. Netflix, oops, that is not Netflix, that's Namaste. Netflix, possible double top. If it loses this, see you later. You look at like Coop, right? Software, just the ugliest freaking range I've ever seen in my life. But again, tries to get up, gets knocked down, gets up, knocked down, gets up, knocked down. Finally breaks through, right? Finally breaks through 320, gets knocked the fuck down. Comes back up to 320, still can't get past it again. So you say 1, 2, 3, 4 rejections of 320. It had one opportunity to get up, and the second it did, it got absolutely slaughtered. I think Team looks pretty good, but it had a almost 10% down day today. But a lot of these are you're talking about stocks. You're talking about a sector that is just parabolic, and sooner or later it's going to come in and correct. Areas that are the best place to be right now. You want to look at industrials. You want to look at retail like DBI. These things are not flashy. They're not pretty right now. But listen, these companies, if this country opens back up, this is where you're going to want to be. You're going to want to be in retail, right? G3 apparel, Under Armour, which I think Under Armour is doing pretty good. Nike. So these are the areas you're going to want to be when the country opens back up. Disney, when they open the parks back up fully. So these are the things you're going to really want to look at. So let's talk about some election day scenarios real quick. Where do I got it? There we go. Trump basket, Biden basket. Here we go. Okay, election scenarios. Biden win, blue sweep. Biden win, Senate stays red. Trump win, Senate stays red. Trump win, Senate flips blue. In either scenario, we get one level of uncertainty removed, and that is we learn who the president's going to be. However, the best case scenario, I don't care if you want to hear this or don't want to hear this, it doesn't matter. The best case scenario is a Biden win, blue sweep for the market. Why is this the best case scenario? This is the best case scenario because it is the quickest way to stimulus. And not only just a little bit of stimulus, to the biggest stimulus we've ever seen. Okay? So if Biden wins and the blue and the Democrats sweep the Senate, that is the best case scenario for the market. If Biden wins and the Senate stays red, that means we're going to remain in a stalemate. And that's not going to be fun. But it'll probably end up being it probably ends up being better than if Trump wins and the Senate flips blue. So if Biden wins and the Senate stays red, that's going to suck. But I don't think it's going to suck as bad as Trump winning and the Senate flips blue. Okay. Trump wins, Senate stays red. That's probably your second best case scenario. It is going to still remain somewhat of a stalemate as far as stimulus. So stimulus may take a little bit longer in this scenario, but at least like these two things that have been the way they've been, they stay the way they are, right? So even though that might not be appealing to you, the market doesn't care. So like Biden winning in a blue sweep, like you have to understand that the Democrats have floated the biggest stimulus package so far. And if it wasn't for McConnell in some cases, like that would have already been passed. So you have to understand that. Like you have to understand that any kind of like speed bumps, roadblocks that are in the way of stimulus, is causing the market to be a little bit more volatile. Because here's what happens is fund managers, hedge fund managers, mutual fund managers, institutions, they need to know where to position their money. So if they're not sure stimulus is going to happen, they're not going to place their bets. Okay. If Biden wins, they know they're going to want to be in China. They're going to want to be in renewable energy. They're going to want to be in healthcare. If Trump wins, infrastructure, materials, industrials. He'll probably, the country opens up and vaccine comes out and things kind of get back to normal. In either scenario, 2021, things kind of sort of get back to normal. A vaccine is a piece of uncertainty that's going to help. Getting this election done with is a piece of uncertainty that's going to help. So removal of uncertainty is the biggest key here. I don't think there's anything here that really matters. Yeah, I mean, I just want to remind you guys of this, like this is growth back in the dot-com bubble. This is growth in March of 2020, and it was just way higher. It was like 3 times that in August. So just keep that in mind. Like these things, these great peaks in growth and technology are not sustainable. It doesn't mean that like good IPOs aren't going to come out and be great and everything, but it just means that you can't place all your bets on technology. Technology has been the best place to put your money for the last easily, at least the last 5 years. Ever since 2016-ish, it's going parabolic. I mean, it was already kind of trending nicely, right? Nice little up and down, up and down, up and down, trending nicely. Then all of a sudden, it just took on a completely different angle from there, right? So completely different angle. And now it's even more parabolic, you could say. So just keep that in mind. And it doesn't like necessarily mean that technology is going to crash. What the interesting thing about market cycles is that a new cycle in this market really started somewhere around here. And these cycles last 15 to 20 years. But for right now, this is something that's unsustainable. So just keep that in mind because you already got back in February and March, high to low in technology, you got a 33% correction. Right now, you're at about 14% correction in technology. So just be careful with technology right now. No, it's not exactly fun to be in United States Steel, right? It's not fun to be in Alcoa, and it's not fun to be in ExxonMobil, and yada yada yada. But just understand that in the long run, this is like the next wave of the cycle, right? So technology and semiconductors lead. You can look at semiconductors, right? Here's semiconductors, right? Semiconductors break out, retest, and then off to the races. Your cycle started here, 2018-ish. So just keep that in mind. Like you finally took out your 2000 highs and you came all the way back in 2020. So, if one of the ways to look at this is if you only think the country is, let's just say, if you only think the country is about 78% more valuable than it was back in 2000, you're freaking crazy. So, this country is way more valuable now than it was back then. Here's another interesting way to do that. So if you look at the Federal Reserve Bank of St. Louis does the GDP, right? Let's see. That's not what I wanted. Okay. So I always like to think of this stuff in multiples. So if we were, 10 trillion GDP in 2000, and now we're at about 20, 21 trillion, That's a double, right? Well, you know, we're not there yet. And it's not as easy as that. It's not cut and dry as that. But in terms of market cycles, like we still have a long, long way to go. We really do. So, but it doesn't mean that you just dump all your money into technology and semiconductors and things like that. Like you want to find the stores of value. You want to find the Tupperwares. You know, you want to find something that makes a ton of money, but nobody wants to invest in them because it's freaking Tupperware and it's not software. But you would have what at the high over here is like 20x, 20 times your money. As of today, it's about 17 times your money in less than a year. So just think about that. When money starts rotating into these names, it's going to be really, really important to be a part of them. So, is there anything else? So I showed you this. Yeah, this is always very interesting. If you want to get into the weeds a little bit, I love doing IPO searches. Go into industry. If you want to look at apparel, like Canada Goose has gotten really popular as of late. If you want to get into banks, that's not fun. If you want to get into, let's get rid of stock. Let's do stocks only. If you want to do software, which I think is over here somewhere, software application like Domo, Everbright, so you could go through each one of these, but I like doing it by market cap because it just shows you where the money is being put immediately. And a lot of these companies like DocuSign, everybody knows DocuSign, great company, right? Makes tons of money. But the problem with DocuSign is kind of the problem with everything else, is it just went up way too quickly, way too far, way too quickly, and kind of a similar thing to Coop, right? Where it's kind of just goes up, gets slammed, goes up, gets slammed, goes up, gets slammed, goes up, gets slammed. So, but here's the thing, right? It's like, okay, still an uptrend, looks like it just broke it right now. That's kind of scary. All the good ones, Snap's not good. Snap is garbage. That company needs to go out of business. Tell me how you really feel, right? Let's see. Where's the other software companies? CrowdStrike, very good company. Let's go back. This one is pretty new, actually, right? Yeah, it's about a year old. They haven't ran up as high as some of the other high flyers have. But this one's pretty good. That's not like completely parabolic. I know a lot of my friends looking at DraftKings, which is super cool. Super cool company, but the problem with that, parabolic gets slammed down, parabolic slammed down, still trending, still making progress, but you got to be careful, right? You got to be careful around here. I think we were talking about if it loses this 31, 32 area, that will not be good news for DraftKings. So keep that in mind. What other one? Peloton. Oh, Peloton, another great IPO name. I love the business model. Hardware, software, business model, which is great. Anything with a subscription model is worth investing in as long as that everybody really wants it. This isn't like friggin' Apron, right? Like oh, Apron, oh, they deliver your food to you and you can cook it. It's like, how much more different is that than me spending the extra, 10, 20 minutes in a grocery store? And this is kind of what happens when you kind of have like a good business model, but a shitty product, right? Not like Apron is shitty, but it's like, okay, what's the catch here? Are you gonna ship the food with a chef and the chef's gonna cook it for me? No, I have to still do that myself. All right, it's not really worth the extra premium you put on the food and the delivery. So Apron's a good one. Good case of like stupid at this thing. Unbelievable. I can't believe it did it. I can't believe it. Can't believe it did it. But Snap, it broke its IPO high, off to the races, right? Pins, that's a great. This Pinterest only had a little bit of a dip, then off to the races. What's the other one? Oh, Twitter. Twitter's an interesting one. So this thing just got absolutely demolished today, down 21%. It was a really bad day for technology today. But this is another one that's trying to work its way higher to its 2014, 2013 IPO high. So that's another one when it gets into this thin zone. So maybe give it a few months, let it set up. I really think this thing's going to make another run up to 72. So those are just some IPO names to throw at you. Unity Software. That's it. Maybe that's one last one I can show you. I don't think this is great right now. It's still pretty young. So IPO down here around in the 60s, 70s, up around 94 right now. Could revisit. So just keep that in mind. I think that's a great company. Their software has a lot of applications in gaming and I think in manufacturing and cars. They're a pretty good company. So Roku, if you want to talk about taking over or kind of changing the dynamic of the media landscape, Roku is another one that I'm pretty interested in, except for the fact that it's just gone bonkers. But like if you're trying to invest in these names, you want to keep an eye on them. One of the nice things about these charting platforms, if I just set an alert, right? If I'm like, okay, I don't want to buy this until 170. There you go. So now I have an alert at 170. If it hits 170, I'll buy some shares, right? So that's kind of how you have to look at a lot of these things. One, like if you want to play something like I'm trying to think like maybe a Mosaic. Mosaic's not good. AB. That's not great. Visa, not great. What's that one we just did? CHW, CWH. Okay, here's a good example. So this Camping World just kind of made a really great run, and then all of a sudden it started to create this really nice wedge pattern that technical analysts really like. So one of the things that I like to do in this scenario is I say, okay, like I want to know every time it trips. So the next time it's gonna trip it is gonna be around say 25. We'll call it 68. So 25. We'll call it 65. Okay. So now if this thing is gonna keep coming down and keep getting quieter as it comes down, which is what you want to see, it's probably gonna clip this, and then after it clips this, I'll put another one. And the ideal wedge pattern is what happens is it creates 3 or 4 lows, and then it gets very quiet, and then off to the races. You could see that millions of times throughout charts throughout history. So that's just a good idea if you're interested in some IPOs or any other stocks out there. This way you just get these alerts, and once you get the alert, you could just buy, and you don't really have to think about it, which I think is a really good idea. It takes a lot of the emotion out of it. You just kind of set it and forget it, and then when it alerts you, then you buy it, and then that's it. So that's a really good idea, something you could do. So I think that's it. All right. So again, regardless if you want to hear it again or not, but best case scenario is a Biden win and a blue sweep. That's your best case scenario. We'll get tons and tons of stimulus. Goldman is already like shilling for the Democrats, like, please let there be a blue sweep. If there's a blue sweep, we will make so much money, more and more billions than we already make. So that's your best case scenario. Your second best case scenario is things stay the way they are, which is Trump remains president, Senate remains red, and I highly doubt there will be a red sweep. That's like a 1% probability. So that's not going to happen. But look, long story short, there's going to be some removal of uncertainty. We've been a really kind of like weird range for the last 2.5 years. And once we break out of it, it's going to be just like 2016 where we just keep going up for like 2 or 3 years, right? So just keep that in mind. Don't panic. I've had clients already call in and be like, I heard on the news that if Trump becomes president, the market's going to crash. And, it's tough not to make fun of these people. And if you ever called me and said something stupid like that, I would make fun of you too. So just keep that in mind. But yeah, market is not going to crash. The only thing that could probably crash it is if they decide to close down the whole entire country again. If they do that, then good luck figuring out what's going to happen next. So, alrighty, everybody. Good luck out there trading, investing. Try to not let the craziness of the election take hold, and just chill, relax, big deep breaths. Everything's going to be okay. The world is still going to turn after it is all said and done. So have a good night. Call me, text me, email me if you have any questions about investing or trading, and I'll talk to you later. Have a good one.